Rand Merchant Insurance Holdings holds a portfolio of insurance investments including MMI Holdings, Discovery Outsurance and RMB Structured Insurance. It is a 35% held by Remgro. It has a market cap of 25 billion Rand, a dividend yield of 3.4% and a price to earnings ratio of 16. Before we get into things, the business model of RMI.
Well, I think before we get into it, I just want to disclose that RMI, through RMB Structured Insurance, owns 20% of Truffle. Yeah. So they made a fantastic acquisition earlier this year. And we hope that that'll really pay off for them in the long term. Sorry, what is your question again?
Your thoughts on RMI and the business model that it's got?
Well, I mean, so RMI, you need to break it down into its parts. I mean, RMI owns 25% of Discovery and a similar amount of MMI, and if I put the valuation together, that's roughly, again, 25% Discovery, 25% MMI, and then the big chunk is Outsurance. And it's the value of Outsurance and what you think Outsurance is worth that really determines whether or not you buy RMI.
Whether or not to buy RMI. They're also in Australia. Paul, your thoughts on the operations in Australia?
Look, I like this operation because I like the RMB group generally, and this is obviously one of the products of the reorganization of First Rand and RMB and all the rest of it. So for the first time now you can actually own First Rand and get those assets, and now you can own RMI and own these. It's a little bit of a carpet bag of different interests. So obviously 25% of Discovery, wow, Discovery's done so well, so that's great. It's got the MMI thing, which is a combination of Momentum and Metropolitan, more active in life and funeral related cover. I'm summarizing a bit, they also do a whole lot of other things. But then as Jonathan says, Outsurance. Now Outsurance is a very visible business, has about a 9–10% share, I think, of the local market. Their whole pitch is that you don't need the broker. They have a call center based thing, lots of technology, but it has really done well and it's gained quite a lot of market share. So, I mean, I think that's fine. The only question for me is, does one want to buy a thing like RMI and get all these other bits and pieces in a kind of managed, non-managed, semi-managed, minority shareholding type structure? I'm not sure if this is the ultimate end point of this restructuring. But you know what? It's got 25 billion of market cap and it's one single entry point into some pretty exciting assets.
They've just recently listed on the JSE. Let's have a look at the share price at this stage, around 19 Rand, somewhere there.
Yeah. Look, I mean, RMI, we've owned it for quite a while. We actually recently got out of it. Just based on Outsurance, I mean, if you look at what's happened in the personal lines business, where you look at Australia, it's about 80% is written by direct insurers. In South Africa, the percentages are reversed. And in the UK, it's somewhere in between. So you can certainly see what's going to take more market share over the coming years. There are going to be less brokers and more direct insurers. So, I mean, there's certainly a lot of growth in that. The problem that I have with Outsurance is it has an underwriting margin of 50%. So that means for every 1 Rand that somebody's paying for their insurance, they're only getting 50 cents back in actual claims. And if you look at that compared to the other insurers, it's extremely high. And I just worry that they're going to either have to reduce that in order to grow a bit more, or otherwise keep it there, and then they won't be able to take as much market share.
Now, Paul, if you look at the Outsurance life here in South Africa, has been doing pretty well of late. Your thoughts on that business segment?
Well, that's what Jonathan's saying. They seem to be viewed universally as a well-structured, well-priced product, but their margins appear to be higher than everybody else's. So it's not entirely clear how they pull that off. Look, there is certainly a part of the market that wants to be in relationship with a broker in order to have their insurance taken care of, particularly at times of strife and so on and so forth. But there are definitely those people, typically younger, more technologically astute, more price sensitive, that are likely to respond well to this kind of product pitch. So I don't think there are major problems there. I think they're going to continue to do well. But let me just say that it's still the same basic business model. Still the same issues with regard to cyclicality in the business. The specialized risk environment also worries me a little bit. Once companies that are in the insurance game start getting into corporate insurance, it starts out with insuring the chairs against flooding and the artwork on the walls. But then you start providing business process insurance, and the next thing you've ended up with AIG and you're selling AAA ratings, and there's a financial crisis and your entire reserves are wiped out. So I'm being a little bit dramatic here perhaps, but at the same time for me there is the issue always with insurance, and that is that as good as you are, your actuaries may not ultimately anticipate all the risks that could befall you.
So hot or not in this one?
No, I'm going to go with not hot again.
Still not hot. RMI, your thoughts on RMI, hot or not, Jonathan?
Well, I mean, as I said, we recently sold out of it. I mean, we sold out of it closer to the 18 Rand mark, so it's gone higher. But I mean, so at this point, we see value in other areas, so it's not hot.